Hi, this is Mark with ValueCharts.com. Welcome to the Extreme Red Snapback Options Strategies Workshop. This is a great strategy, and I'm going to show you today that works very well in both stocks, futures, and Forex, although today I'm just going to cover some examples, specific examples in the stock market, and I'm going to use an indicator called the ValueCharts price window to point out or capture or flag these trading opportunities that evolve over time. And literally what's really exciting about this type of trading opportunity is that there's a lot of different permutations to it. So there's a lot of different ways you can use this in your trading, and it is extremely powerful and one that you definitely want to have in your trading toolbox. Now, before I get started here, let's go ahead and take a look at my background. Now, I'm basically coming from about 20 years in the hedge fund industry, have been blessed to be a part of some Star Search winning teams, and have also written a book called Dynamic Trading Indicators, which features the value charts concept, which I came up with as an engineering student in the early 90s. So these are the things that I love to talk about, obviously, and I believe that they represent some tools, trading tools, that you will certainly want to have in your trading toolbox. I've also been a domestic and international speaker at different trading events and have been a frequent commentator on CNN Money as well over time. Now, let's talk about the risk disclaimer. Trading or investing carries a high level of risk. It is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. Bottom line, if you trade, make sure you trade with money that you can afford to lose. There's no guarantee with any strategy out there that you are going to achieve profitability. Now, taking this a step further, also be aware of CFTC Rule 4.41, and this basically says that hypothetical or simulated performance results have certain limitations. Past performance is not necessarily indicative of future results. Okay, so don't get super overly excited about any hypothetical results in the markets, or even real results for that matter, because markets change. They transition from one type of market to another, and that always keeps us on our toes and keeps trading challenging. Having said that, we always try to find the types of trading strategies that we feel like give us an edge in trading. Now, let's go ahead and talk about the Black-Scholes model, or the Black-Scholes model, in determining the value of an option or the premium for a specific option. Now, let's take a look at the formula here. And what's interesting to note is that if you look at the definition, so C really represents here the theoretical call premium, or the value of the option. Now, let's take a look at some of these variables or parameters within the formula itself. S is the current stock price. T is the time until expiration. K is the actual option strike price. R is the risk-free interest rate. And then we reference with N the cumulative standard normal distribution. And then we also have some other things here as well. Now, the reason why I look at the formula here is what's interesting to me is that there's no reference or accounting for the valuation of a market. And part of the reason why I think this is because back when this formula was first created, there was no tool or there was no formula out there that accurately calculated or accurately communicated the objective valuation of a market and time frame combination. Now, having said that, even with value charts, we still have markets. Obviously, every market out there has a unique valuation for each time frame within a single market. So you could have a short-term undervalued and long-term overvalued picture for a market. So value or objective valuation, even in itself, can be a complicated topic, but the fact that the Black-Scholes model does not reference value in it is very interesting. So in other words, as I calculate the value or the premium for an option, it doesn't matter whether the stock or the underlying is trading in fair value or whether it's trading significantly overvalued or significantly undervalued according to this formula. Now, That's important to understand because I believe that creates a significant edge for us. Okay, let's go ahead and advance to the next slide. The Black-Scholes model makes no distinction between different valuations, as we saw from the previous formula. Now, just as a side note, I apologize. I'm actually struggling with allergies, and if my voice sounds a little bit funny, it's because I am in the peak of allergy season down here in Austin, Texas, so forgive me if I sound strange or a little congested. That's just part of the territory down here, and unfortunately, I can't do a lot about it. But so just bear with me with that. Understand again, Black-Scholes model makes no distinction between different valuations. Black-Scholes model treats fair value the same as significantly overvalued or significantly undervalued. Okay? Now, why this is a potentially interesting edge for us is because if you have prices at significantly undervalued, let's say the market's run up and then sold off, and it's in a trough and it's undervalued, there's a higher probability at this point that prices are going to bounce back up into fair value and maybe even go overvalued than there is of the price continuing oftentimes. Using the value charts indicator to define fair value, overvalued states, and undervalued states, this potentially creates a great edge for us as traders. Okay, taking advantage of one of the weaknesses that I perceive in the Black-Scholes model. Now, this creates, again, a significant opportunity for us. Value relates to the psychology of how active market participants or active traders view prices. All right, so if you think about any market out there, for example, real estate in Florida in the early 2000s, if you looked at a waterfront property, even a really old one that was built back in the 70s, sometimes these properties and canals would go for $150,000. And we saw in a short period of time, maybe about 2 to 3 years, that these properties that used to sell for $150,000, they shot up to about $500,000 in about 3 years. Now, the psychology of the average person in that market, those prices felt overvalued. But as the prices stayed fairly high, obviously there's a limited supply of waterfront properties, then the value would start to become known more as fair value or more widely accepted. So there is a psychology in every market in the world, including stocks, futures, and Forex, for how prices are perceived as being fair, overvalued, or undervalued. Okay? And this again relates to the psychology of how active participants view prices. Now, something that a lot of people don't know, in fact, let me pull up my drawing tool here, is that value can be measured. Okay? Most people don't understand that. So when you think about value, or think about in terms of the psychology of a market, you can measure psychology. In fact, it becomes a very powerful form of analysis in a lot of different markets. The understanding the consumer confidence, for example, is fairly important for stocks. It's an important number to look at. Understanding how enthusiastic buyers are or how they're feeling. It becomes fairly important to understand all these things. So value is a perceived attractiveness or unattractiveness of price. So at certain price levels, the broad market may say this is priced at a level I'm comfortable with. I think this is fairly priced. As the market starts to shoot up, then as the prices start to really increase, or the price discovery process pushes prices higher. Higher prices up here tend to be viewed as overvalued. And then as price discovery pushes prices back down into fair value and then down undervalued, the broad market could start to view these lower prices as undervalued. So value can be measured, and we use the value charts tools to do that. Now, traders often take profits at extreme value levels because they feel that prices have gone too far. This is something that we can take advantage of, especially as prices start to get too far. Fear sets in, greed sets in on the upside, and then even the electronic trading today with the high-frequency traders front-running, orders, it exaggerates that overvalued or undervalued effect, if you will. So these are great opportunities for us to take advantage of. So traders oftentimes take profits there, and what we're really after here is what we call a value reversion, or prices going from undervalued or extremely undervalued back up to fair value, or going from significantly overvalued back down to fair value. That's what we're looking for today. And we're going to utilize the ValueCharts tools to identify when prices have indeed become significantly overvalued or undervalued. And then also we'll be able to identify when they come back up into fair value as well. Now, profit taking from extreme value setups causes a snapback effect. And this is what we're trying to take advantage of. So once we get into, for example, significantly overvalued territory, after prices run up, we are looking to potentially sell, okay, and not risking a lot here. And then as prices go in our direction, if we're fortunate enough to have the trade work out the way we want it to, then we look to take profits after prices have fallen off, or vice versa, buying on the downside. Okay, now we can use this information to our advantage, or this tendency to our advantage on any time frame. So these opportunities do present themselves both end of day and intraday as well. Extreme overvalued or extreme undervalued prices can often represent extreme points in price bars. And that's great, because obviously if we had the ability to sell at high levels and cover our shorts at fair value, or buy at undervalued extreme low points in prices and cover at fair value, then this could create a great opportunity for us to identify some nice trading opportunities. We can use this to our advantage when trading options. Okay, especially intraday. I'll go over a few end of day and intraday examples here, or ideas that we can use, or strategies we can use in trading options. Now, be careful about post-earnings price action. Implied volatility can be crazy. The market needs to gather itself. So when you have a market shocked, like Apple recently had an earnings report come out that was better than expected, prices gapped way up. And after that happens, you want to just let, according to what we're talking about here, you want to let things kind of settle down. So there are other strategies that you might want to take advantage of when that happens. But with what we're talking about today, if a market gaps higher because of a news announcement or because of earnings, we want to make sure that's not the type of strategy or signal we're looking for today. So we want to make sure that the supply and demand factors in the market start to smooth out a bit. And we want to have the market gather itself and look for more non-event created opportunities that present themselves on a frequent basis in the markets. Be careful holding long options on the previous Friday, 1 week out to expiration. So in other words, if next Friday, 1 week from today, let's say today's Friday, next Friday is expiration Friday, be careful about holding long call options or long put options over the weekend. And the reason why is because the options contract is going to experience a sizable amount of time decay. And the reason why is because 2 days out of the 7 days are over the weekend, take place over the weekend. And this is actually, when you think about it, it's actually more than 2 days. So you have 2 whole days and really a night session. So this represents a large percentage of the time that's left in the options contract. So I typically tell investors, be careful about holding long options over that previous weekend before expiration week. And then also same thing, holding overnight Thursday before Friday expiration. Same principle, because if you buy it Thursday evening, if an options contract expires tomorrow on Friday, that night, all night long is quite a bit of the percentage of time that remains in the options contract. So you don't want to be bled dry by the time decay in that, and you don't want to lose, from a long perspective, you don't want to lose a lot of premium value because you bought right before the market closed over a time period that represents a large percentage of the options contract remaining. So again, the previous Friday over the long weekend, be careful about holding a long options position. Same thing Thursday night before expiration. Now, just to highlight these points here, I keep on right-clicking here. Let's see, right here again, this is the Friday before expiration. So if you look at this timeline down here, it expires right here at the end. This is a sizable amount of the time period left. So just reiterating the point, time value, time decay is happening. And then right here, you can see how this time decay curve really starts to accelerate near expiration. And so this Thursday night to Friday session, this whole amount of time right here is a good percentage of what's left in the options contract. And you see, again, a increasing acceleration in the time decay of the options. So that's why you don't want to hold on to a long position during that pre-weekend, Friday before the expiration week or Thursday night period. Again, this gives you a visual of what time decay is doing the week of options expiration, going obviously into that final Friday. Okay. Extreme value snapback options trading opportunities do not last long. Let me emphasize this, okay? When you find great deals in the markets, they typically do not last long because there's other traders out there looking for a great deal, if you will, a great trading opportunity, and they tend to, if you're on your toes, they tend to pull the trigger when this comes around, especially disciplined traders. So make sure that when you're trading, you have ways to flag these opportunities or to track these, and when they come up, you need to make sure you're ready to pull the trigger and understand the strategy that you want to utilize, because these options are short-lived. They oftentimes may only last a few minutes. So if that's the case for a shorter-term intraday option, you need to be ready with your strategy already pre-thought out. And if it's an end-of-day strategy on daily or weekly charts, you have a little bit more time to react. But at the end of the day, you want to make sure that you go in prepared, understanding exactly how you're going to take advantage of those types of strategies. Now, let's take a look at the Master Value Charts window. This is utilizing the Value Charts tool on Bloomberg. And you see right here in the upper left-hand corner, we have the normal open, high, low, close bars, and this is using, in addition to that, an overlay tool called Value Bars. Okay, so that's nothing new here, open, high, low, close bars, but Value Bars are a great tool. They essentially are projecting the color here from the Value Charts price window that's below the traditional price chart onto the traditional price chart. Makes it a little bit easier to see what's happening there. Now, in the lower left-hand corner here, this is what's called a Value Charts price window. This is designed to plot price in terms of objective market valuation. Now, objective valuation can indeed be measured, and the Value Charts tool is what I use to measure it. So understand also, you'll notice over here to the right, there's units over here being used in the Value Charts price window. So let me go ahead and erase some of my drawings here. So these units right here are not the same as the units up here for Apple. So these are dollars per share up here, right? These units down here are dynamic volatility units. They are different. They are designed to expand with increasing market volatility and contract with decreasing market volatility. So notice here, these units are the same as the units over here on the price action profile window over here. So this tool, Value Charts, again over here on the left-hand side, lower left-hand side, is designed to, again, plot price in terms of objective market valuation. It has 5 primary valuation zones, color keyed, fair value here in the middle. You have moderately overvalued, upper yellow zone, significantly overvalued, upper red zone, moderately undervalued here, lower yellow, significantly undervalued, lower red zone. Now notice that the color schemes match up from your Value Charts price window over to your price action profile. In fact, I'm going to erase my drawings again here. So upper red to upper red here, right? Upper yellow zone to yellow here, and then green to green, etc. So these represent the same thing. The units are the same. So these numbers are dynamic volatility units here in the price action profile as well. Now, the price action profile is designed to communicate the degree that a market is overvalued or undervalued. So Apple Computer right here is trading in the upper end of fair value. It's in the green area, and it trades at or above this area 30.98% of the time, trades at or below 69.02% of the time. So this is where this information can start to become powerful. Now what's interesting here is take this low level down here where the price bars using, again, this is a monthly chart in Apple, very long-term perspective. poked down into significantly undervalued. Okay, now if we go over here to the price action profile statistics, we'll see that Apple on a monthly basis trades below or within this red region, significantly undervalued. So if I circle this entire red region here, it trades within that region 2% of the time. It may be hard to read, but that's 2% right there. Now it trades in the upper region. Let's see these points where the bars pushed up into significantly overvalued. Trades in those regions, or that region, 1.7% of the time. So think in terms of prices only trading in significantly overvalued or significantly undervalued less than 2% of the time. Now, as I mentioned before, the Black-Scholes model does not distinguish between significantly overvalued, less than 2% of the time of value price behavior, or significantly undervalued, and fair value. Now, my experience has been quite often that two things can happen in a market. All right, either a value migration or a value reversion. Don't let those words scare you. Value migration means that a market pushes up into overvalued, like right here, and just continues to be overvalued, like Apple did right here, and then eventually got significantly overvalued on a monthly basis and had a fairly sizable correction of probably over $50 a share. So this represents value migration, or can. Whereas if you look over here, this is more of a value reversion. Shoots down undervalued, moderately, and then significantly, and then you get your rebound into fair value. So we're interested in finding opportunities that take advantage of value reversion, going back to fair value, snapping back from an overvalued or an undervalued price extreme or value extreme back into the fair value territory. And keep in mind that this green zone right here, in the price action profile, or this green zone, which is the same thing in the ValueCharts price window, represents about 68% of historical transactional price activity. So the majority of buying and selling happens in the green area, less so in moderately overvalued or moderately undervalued, and then very little, less than 2% in the upper red here, the significantly overvalued right here again, okay, or significantly undervalued portion of the value charts. So that's less than 2% typically, historically, price action takes place there. Now, I put some flags there just to flag the significantly overvalued and really significantly overvalued. And I don't know why I keep on right clicking here. I'm used to GoToWebinar. Apologize for that. So right here, this flag is calling out attention to price bars that barely poked up. You can see the red tip there, barely poked up into significantly overvalued. And then down here, you can't even hardly see it, but the price bars barely poked down into significantly undervalued. Now, even though this significantly overvalued price flags right here were not the ultimate top, you can see that prices still experienced a fairly, they traded sideways and they corrected from these levels. Doesn't always have to happen that way, okay? Prices sometimes under extreme situations can even push farther into significantly overvalued or significantly undervalued territory. That can happen with a short squeeze or a flash crash. In a flash crash, prices can take off, become significantly undervalued, and just start to crash. Now be aware, those things can happen. That's a value migration when that does happen. So right here again, significantly undervalued prices here, snap right back up into fair value. These are the opportunities we're looking to take advantage in trading. And again, you can see this on a weekly basis. This is using a 5-bar weekly. I was using 14-bar analysis period in my value charts on the monthly. What's interesting is that sometimes markets will have their unique tendencies. So on a 5-bar weekly, you can see my value charts indicators doing a really good job of nailing the extremes here. These are great opportunities for option strategies here. Even though, like for example, this first one over here was not the ultimate low, it's still bounced back up. You still see prices bounce back up probably about $50 a share. So great opportunities to snap back here in a fair value. All right, for these buying opportunities. And the very bottom tips, you'll notice, of these price bars are what we're seeing here as our buying opportunity. That's where we want to buy, is when it's significantly undervalued. If we have especially if we have other compelling technical analysis or fundamental analysis telling us that the market may be bullish, those are great opportunities to throw on either a neutral option strategy or a bullish option strategy to take advantage of that. And I'll show you here in a minute how both can be used effectively to be profitable. Okay, again, right here on the long side, you see a lot of these lower flags are flagging significantly undervalued price points. You see these down here in the value charts price window. Okay, and you also see them in the value bars up here in the chart. So it's communicating at both levels. I love the value bars because it makes it really easy to see where that's happening when I look at my open, high, low, close charts. And again, you see what's interesting here with where Apple is on a weekly time frame. It's trading at 9.6, which is way up in significantly overvalued territory. Historically, it trades at or above this 0.38% of the time, so less than 1% of the time. Trades below this on a value perspective 99.62% of the time. Now, it's important that you understand that this alone does not guarantee that prices are going to revert back to fair value. It just says that there's a high probability of that happening, or an above average probability of this happening. Now, it's not uncommon for a market to push into significantly overvalued right here, like it did on this particular flag, and then it traded sideways for 2 weeks. Did here, pushed up here, traded a little bit sideways, snapped back a little bit here, but it can. So as markets trade sideways, then they become less overvalued because it represents time at price is value. It's market acceptance. So now, we're not going to go too far into value today, but understand that value can be a deep subject, and that's good because it means that it can be a very powerful tool in trading. Now, this is a nice view of just seeing these opportunities on a simple price chart, again using value bars. The red portions below here are significantly undervalued. Good long option or neutral option opportunities here on a weekly chart, and then you have the short option strategies. When I say short, I mean bearish option strategies or neutral. We could even take advantage of neutral. So let's go ahead and take a look at several different option strategies we can use more for kind of a swing trading, longer term strategy on markets. Okay, let's go ahead and advance the slide. Now here's what I recommend looking at just for some very basic strategies. If you're a more advanced option trader, by all means, use something a little bit different if you'd like. So right here, the call backspread is a bullish strategy. Okay, the put backspread is a bearish strategy. So at the significantly undervalued points where I'm looking to potentially be a buyer, call backspread might be a good option to use. When I'm looking to bearish a market, looking for prices to go down, the put backspread could be a good one to use as well. The neutral strategies down here at the bottom could be used either for falling prices or rising prices, the long straddle or the long strangle. Let me go ahead and dive right in to show you what these look like. Now, you'll see here, I'm going to throw up my green pen again here. This is what we call a long straddle. It's simply buying a call and buying a put at the same strike price. Now, when you talk about prices starting to shoot up into significantly overvalued territory, what you want to do is find the strike price that's as close as possible to where prices are currently. So you just look at your chart, and what I tend to say, let's say I'm looking to sell or I'm bearish a market. When I say sell, I'm bearish a market. I'm looking to buy options. Then what I want to do is if I can't find a strike price right at this level, let's say they're kind of bracketing my current significantly overvalued level here, I tend to favor the out of the money strategy here. So if I'm looking for getting a long straddle, I could favor maybe buying the straddle at this point in time. Now, there's a word of caution here. Actually, what I might suggest you do in this case is if you're significantly overvalued, is splitting two strike prices, you might even want to go with the long strangle. Okay, that's buying the call option up here and buying the put option down here. So you're buying the call up here, buying the put option down there. Okay, let me clarify this. I'm gonna erase my drawings here and do this one more time. So if you have let's say you have prices that are significantly overvalued, they've run up. Here's what I recommend you doing. If your current price level, here we'll draw a dashed line here, is splitting two strike prices, one thing you could look at is getting more of a long straddle from the upper strike price here, because you're gonna lose less money on the long call. I mean, your expectations are that prices are going to taper off and start to head down here. So I would say you want to use for the straddle the higher strike price here, or look at that potentially, and even practice this before you even place these types of trades to see if this gets you the results that you're looking for. Obviously, results being profitability. But if I had to have one strike price in the money, I definitely would like to have my put, because that's the side I'm favoring right now. All right, but if another idea would be to use the long strangle. So, and I'll show you that next. And that would involve buying the call at the upper bracketed strike price, buying the put at the lower bracketed strike price around where current price levels are. Okay, so again, the straddle is buying one call and buying one put at the same strike price. This is the profit curve, if you will. Your maximum exposure is right here if prices stop and do nothing. The great thing about significantly undervalued or significantly overvalued price activity is typically you see one of two things happening, and that is oftentimes a snapback, or quite often you could see a market in very unusual situations going and thrusting forward further into overvalued or undervalued territory. In that case, either way, we're profitable. This is a neutral strategy, and so long straddle could be one you could consider. Now, the long strangle here, again, is buying and selling the options that are slightly above or below the current price level. So buy one call with higher strike, buy one put with the lower strike price, and this gives us a little bit less expensive of an option. But I guess the downside here would be that unlike the straddle, then you could be entering profitability a little bit later. See how prices have to go beyond the strike price on the up or down side for our profit curve to start working in our direction, and then you have to make up for the cost of your two premiums before you actually experience profitability. All right, so the straddle to me again might be a little more preferred than the strangle, but strangle may not be a bad idea either. So check them out, practice this first, and then make sure you have a thorough understanding of how this works, and see if a neutral strategy might be something you may want to consider for these types of setups. Now, I'm going to show you here in a minute some intraday examples of extreme overvalued, undervalued setups that you can use. You can use these also on end of day as well. The same concept works for both. Okay, now another call option strategy you can use. This is a bullish strategy. Is what's called a call backspread. And what you're doing here is you're selling one lower price strike. That's this one right here. Okay, and you're buying two higher priced. So this is the one, selling one lower priced and buying two higher priced. Now what's interesting here is you want the sale of the lower priced call option to be more expensive or more money than the cost of the two higher priced calls. And this gives you the profile here where if the trade goes dramatically against you, then you can still achieve a certain level of profitability. If it goes in your direction, then you do get the same type of curve that you would with a kind of a long call position. So this is a bull market strategy, and you can play around with the different strikes. I would say you probably want to use two possibly out of the money calls, although you could use two at the money calls and one in the money call. So play around with that and see how that works out. But to me, the profitability scenario of being wrong, being slightly profitable, doesn't really matter so much. I'd rather be profitable quicker on the upside if it goes my direction. And but this is a nice situation here. At least you're not, with a naked call, you'd have a profit profile like this, where you'd have, if you were wrong, you just have the loss of the premium. And at least with this scenario, you have the opportunity to make back some of your premium, if not even achieve a small profit here if the trade goes completely against you, which again is a nice situation. The put back spread is just the opposite of the call back spread. So it means you're selling one put that's in the money or higher priced and buying two puts at a lower strike price. And you can play around with this with respect to where current prices are and see if your options platform can give you several different types of profiles here that would show you where you could eventually achieve profitability. And again, as this is a bearish strategy, so as prices fall in the underlying, we have the potential to do very well with this type of strategy. So I like this, something worth considering. And the other thing to make sure is what I do is I want to always work these options orders in the market. I don't want to go at market usually check out the bid-ask spreads for each one of these strike prices and make sure that it's not unreasonable. If it is, you may want to see if you can split them, put your order in between the bid-ask spreads, so you're not putting yourself out of pocket too much with the cost of this option strategy at the get-go, and then go from there. All right, so let's take a look at some real-life, shorter-term examples that I found this past week. Now, one question I would have for you is, would you have bought this put option here in Apple last week? And I say, Mark, how in the world, why would I have bought this put option right here at this time frame last week? In fact, let me go ahead and change my ink color to blue. So right here, would I have gone long this put option, which obviously ended up appreciating, the premium ended up going up in value last week. Let me show you what could have triggered or tipped you off into wanting to do that. Okay, now, what I've done basically is I've applied 3 ValueCharts price windows on my screen, and I'm using a different analysis period for each one. So 5 bars is the shortest term analysis period I would use. I'm applying this to a 15-minute chart up here at the top. Okay, 15 minutes. And again, my writing is my pen writing here is a little sloppy, so let me go ahead and rewrite that. So 5 bar here for this one, 5 bar look back period, 14 bar look back period for this ValueCharts price window, and the one on the bottom has a 21 bar. So each of these value charts, even though they're all being applied to 15-minute charts, they give you a different time perspective on valuation. With ValueCharts price windows, keep in mind that you can change your time perspective. Remember, value has across all time continuums, if you will, or across the different time intervals is unique. All right, so each time interval, short-term, medium, intermediate, long-term in a market has a unique market valuation. It's important to remember that. We can take advantage of that, though. So now what I'm looking at here is, see the very tip of that price bar is red. That's significantly overvalued, typically less than 2% of price action. Same thing goes down here. The tip of this is red too. The very tip of the 21-day is red too. So I created a value flag, or multiple value flags up here, to call attention when that happens. And you'll notice with these price bars up here at the top, so that I'm circling here, this one in the middle, that has 3 dots above it right up here. All right, so that's signifying a overvalued condition across multiple time frames. Okay, so what I'm wanting to do now is I want to buy just an outright put for this type of strategy. Now, in this case, this is the Wednesday before expiration. So expiration actually takes place over here on Friday, and I don't have a lot of time. Now, because it's Wednesday and not Thursday, I could potentially opt to hold this overnight, but I don't want to hold it really beyond that. All right, so let's take a look at our options chart again here for what happens now. Again, let me just digress here. Notice again, significantly overvalued on Apple. This is using one time frame, happens less than 1.5% of the time. So I'm going to circle this right here. We get that from the price action profile statistics that this is a very rare occurrence. So when it pokes up, you can see the tops of the bars barely poke up here, then that is a fairly rare occurrence, and it's one that I may want to take advantage of. Now you see that happening right here. See how it's significantly undervalued? This is just one time frame now, but it keeps on selling off here. That can happen. It trades sideways really for a bar or two first, and then it sells off. So it doesn't always have to snap back immediately, but what we're after here is finding an incidence where we have significantly overvalued or significantly undervalued across 3 individual time frames. And you can see what happens here with our option. So if we would have bought the put option outright, and that is the 600 put that expires on May 2nd, the price would have been probably around $5.50 here. Take it over here, conservatively. This actually appreciates above 10, so even above 11. So this is a 150% increase here, depending on where you bought it, in the options price in about 24 hours. So not a bad deal there. And what you want to do, I often end up wanting to risk maybe about 50% here of my option premium, but you be careful about putting in order, stop order in the market. Now, I say that you always want to use stops, and most of the time you want to put those in the market. Now I say that because make sure you're aware of the width of the bid-ask spread in the options market. You don't want a really wide bid-ask spread to take you out of this trade right down here before you have a chance to have it go your direction. So, play with that in your mind. If it hits your uncle point, you may want to get out with a 50% loss, or you may want to risk the entire premium possibly of your option. So I typically think in terms of risking about half of my premium and then taking at least 100% to the upside when I see these types of trading opportunities. Now, going over to Google last week, this was on May 1st, would you have bought this put option here for Google? Right here. And you may say, well, Mark, why would I have bought that put option? Well, because we have the same type of triple significantly overvalued occurrence on Google. And this is again on a 15-minute chart. I use the value flags to call attention to this and create a very short-lived opportunity shortly after the open on May 1st. So, and again, we see significantly overvalued in the 5-bar look back, significantly overvalued on the 14-bar look back, and significantly overvalued in the 21-bar look back. So this is the exact same indicator 3 times in a row with different settings. And this is a linear indicator, okay? So that means this oscillates around the 0 axis for all 3 of these. So if you had a 0 axis drawn, and I'm not drawing a very good straight line, these are linear. The price chart at the very top is not linear. Okay, that's just plotting price with respect to absolute 0. All right, so let's see what happens here. Going over to our option price here, you can see that it actually right away, we see that this rockets up in terms of value. So right here, if we would have bought down here, call it maybe around the $3 level, we see prices go up to $6 and beyond literally within an hour. So you have to be ready. If you experience the snapback right away, you want to have your limit order in the market potentially to get out. This is a very short-lived deal we want to take advantage of. You don't want to hold long put options or long call options for an extended period of time this close to expiration. This is on the Thursday before expiration Friday. All right, and you certainly don't want to hold a long put or a long call option overnight. Now, there's another interesting trading opportunity in Google here as well. Now, look here, right after the open of Friday. This is the last day. This option contract, the 5:30 put right here is expiring on Friday this day. So during this day right here, we're going to see that option contract expire. So we want to be vigilant at running with our profits when we get an opportunity like this. Now, why would you have wanted to buy the put there? Notice right here you have 2 of the 3 dots here, all right, but not the third one. This doesn't totally qualify in terms of the triple red in a confluence here with the value charts, but I've got 2 out of 3. Now, when I have an expiration Friday and the market opens significantly overvalued like this can create a great trading opportunity for me with put options on the, if I'm bearish, or call options when I'm bullish. So we can see some dramatic movement here. This is expiration Friday. I have 2 dots up here. You can barely see the top one. I made the dot colors, by the way, something that contrasts with green, red, or yellow, just so they're easier to see. And now let's take a look at the value of the option premium. And we can see here that it was as low as $1 a share, and it goes up above 4. So you're talking about, actually I say 400% increase. That's actually not quite right. It's actually a 300. Correct that. 300% increase in 2 hours. So that's not a bad deal at all. Really, within the first hour, you could have ran off with 150% profits right in here, or if you wanted to hold out for a little bit longer, you could have taken about 300% profit potentially up in this area. So this is an expiration day Friday deal. It very short-lived. These are 15-minute bars. So in the first, call it 15, 20, 30 minutes of opening here, the market is significantly overvalued. That's why we're buying a put option, which appreciates in value when the underlying market sells off. So another great opportunity here, and that works out fairly well. Okay, now let me show you an example on Amazon here. This is an example of following our triple dot rules here on Thursday, which is May 1st, 1 day before expiration. Expiration Friday is the next day. We have 3 dots here. So it meets our requirements of significantly overvalued across these 3 value charts indicators. However, we see that this is actually a signal that didn't work out. So we see that prices do not snap back really. They kind of linger. On this particular case, what I would do is if I bought, let's say you're not buying necessarily right at the open, because that's not when the signal didn't occur until a few bars after the open. So you're probably buying maybe around $4.50 here. Hopefully, you're looking to put your stop maybe around $2 a share. All right, you want to make sure the bid ask is not crazy or going to stop you out on that. But it doesn't stop you out here, and it doesn't go your direction. You don't want to be bled to death here with your time decay. So in this case, I am going to be out at the close. So you're probably going to be out maybe around 350-ish or so, hopefully. So that's where you want to get out. You do not want to hold this overnight. It has not snapped back, and you want to just take your quick little 30% loss or so and live to trade another day. Now what's interesting here is, let's go to the following day. Right after the open of Amazon on expiration on Friday, we had a great buying opportunity for the put options again here. So take a look at, you have the 3 bar, the 3 flags are calling attention. Right after the open, it rallies up into significantly overvalued, again, across the 5 bar value charts, 14 bar value charts, and 21 bar value charts indicators. So I've got my value bars up here, value flags that are calling attention to this real time, and I want to buy a put option fairly quickly. So I'm looking at buying the 310 put, and again, you can see, this goes from $1 to over $5. So that is a real 400% increase here in about an hour. So really nice trade there. Very short-lived opportunity. Again, one of the weaknesses of Black-Scholes is that it does not consider value in its calculations. And that's what we're taking advantage of. So all these people who are pricing these options out there are not considering the fact that Amazon is significantly overvalued across 3 different value charts indicators using the 15-minute chart, and we can jump in as day traders and take advantage of this. Okay, now we have a options class coming up here. Weekly Power Options Strategies with Dave Aquino. Dave is a great trader. So he's really, he uses a lot of creative ways to approach option trading. He had this class a month or 2 ago, and people raved about it. So it seemed like everybody really enjoyed it, and so we're doing it again. This is normally a $300 class. This is being offered for $97. So if you have not had a chance to see Dave teach this class, I would highly recommend it. He uses value charts among other tools, and he talks about how you can trade the weeklies with in several different ways. So you can use options for consistent daily profit trading options, best stocks and options for daily and weekly trading, consistent high probability credit spread trading, swing trades 2 to 4 days. This is a new one right here too. Harvest time premium utilizing VIX ETF spreads. So he's got quite a bit of unique approaches and unique strategies that he uses. But it's, to me at least, I pay $80 to fill up my SUV with gas and $97 for any type of serious trader. I would certainly recommend you check his options trading course out. He does a really good job. Dave's a great guy and very thorough, great teacher, if you will. And Dave actually comes from managing, I believe, a fund, if I'm not mistaken, of several $100 million with Merrill Lynch. So he's been around the block. He's a very experienced and seasoned investor and a great guy. So check it out. Go to ValueCharts.com/power. All right, that's where you're going to find this deal. So go to ValueCharts.com/power, and you'll have the sign-up sheet there online, and you'll be able to reserve your space. If you have any questions, give us a call, 9 to 5 Eastern, customer service, 919-935-0010. Okay, well, great. Thanks for watching my presentation today, and quite a few of you have actually expressed interest in me creating a more extensive webinar or workshop on the content today. There's really a lot of different, very powerful ways to apply this. So I'm going to work on one that hopefully I'll be able to offer later on this month in May that will go over the more extensively how to set up the the red snapback strategies, different time frames you can look at, and that type of thing. What to stay away from, and that type of thing in terms of option strategies or time frames as well too, or even value chart settings. So I'm going to work on that, but in the meantime, I highly recommend Dave Kino's weekly power options strategies with live trading. Now, don't forget, this is on May 6th, Tuesday, 6 through 9. It is recorded. You also get 2 days, bonus days of live trading, 9 to 1 Eastern on the 7th and the 8th. If you can't make these days, then give us a call. We'll try to work with you on 2 other days you can try to get in. But at the very minimum, I would highly recommend buying this course. Even if you can't go, you can watch the recording and benefit from Dave's great teaching. Okay, have a great week. Good luck trading, and thanks for watching.